Good afternoon, everyone.
Good afternoon.
Shivanshu, am I audible? Yeah, okay. Good afternoon, everyone. Welcome to this webinar. My name is Rishi Nathany. I'm Head Business Development and Marketing at MCX. Today we have with us Shivanshu Mehta, who's head of the Bullion products at MCX. We will be talking about the Bullion. He will be taking you through the Bullion products at MCX and basically about Bullion as an asset class. To begin with, I would like to say that among various asset classes in a portfolio, commodities is also a very important asset class. Like when we eat a thali, we do not eat only one item. We have a multitude of items in our thali. Similarly, in a portfolio, all asset classes should be there, whether it is equities, bonds, fixed income, or currencies, or insurance, real estate. Similarly, commodities should also be there in every asset class. According to your time horizon and risk profile. And why I say this is because commodities have unique I always look for tangible investments. So something we can touch, feel. That is why in a conservative country like India, in terms of investments, people like to have tangible investments like real estate or bullion, which they can hold on to. However, given this age of digitization and technology, we are moving more and more towards financialization of asset classes, which means is more the tangible through the exchange. You can take physical delivery, or you can have the gold lying in the warehouse and you can have the receipt of the gold, which is dematerialized and is there in your repository account. Apart from this, commodities also provide you the advantage of being counter-cyclical to various other asset classes. So when it is seen that equities and bonds move up, commodities move in the other direction and vice versa. In fact, in the last 2.5 years, there's been only a 15% correlation between equities and given by the Nifty and our MCX iComdex index. So we can see that commodities can be used when other markets are not doing so well. Apart from that, commodities also provide a very good hedge against inflation. So whenever you are wanting to hedge yourself against inflation, you can always look to commodities. And especially during periods of global turmoil like now, the role of bullion as an asset class within the commodity segment becomes even more important because of its safe haven nature. Because of countries printing more money or currencies depreciating, so bullion offers not only an hedge against inflation but also against currency movements. So given all this, we have a very exciting presentation right in front of us from Shivanshu. And without taking more time, I would like to invite Shivanshu to discuss with you all about bullion as an asset class. Over to you, Shivanshu.
Thanks, Rishi. And I think you have set the tone for the presentation and this discussion. So what I will do is, let me just rephrase and reiterate a few of the points regarding bullion as an asset class, and after which I will get into the presentation. So as you all are aware, MCX and bullion, we've always had a strong connection with each other. One of our leading assets traded on MCX is Bullion, and the beauty is that it's deeply entrenched with not only the retail segment but also the entire bullion value chain. The physical participants you see from the stage of import till the jewelers, they all take part in these contracts for their hedging and delivery requirements. So internationally speaking, to sort of build context for you as a retail product, we thought we'll talk about it from that perspective today. And as you know, gold over the past 5 years on an annualized basis, 15% return. So which is significant when compared to other asset classes. And the turmoil has only started maybe a year and a half back. So I'm talking about a 5-year horizon. I'm not even going back to 2008 and 2008 to 12 time period. So maybe in these 5 years, the other asset classes would have given 5% odd annualized return indices of other assets. So the negative correlation is something which is significant. And if you look at the kind of environment in which we are today, which is actually a negative interest rate environment, geopolitical risk laden environment, currency fluctuation, trade wars, and economic turmoil, both prevailing and expected, as well as the packages provided by governments and central banks, amounting to, some people talk about a figure of 20% of global GDP. So whenever there is a monetary easing, whenever there is a liquidity enhancement, both at the same time, and when the dollar index starts reflecting the low interest rate view going forward, gold immediately presents itself as a relevant asset class. So this is the background, and I will straight away come to my presentation, and after which we'll be happy to, my team is also with me here, and we'll be happy to take questions, and even in between, wherever you feel like you can interrupt. Is this visible to all, the presentation?
Yes, yes,
Great,
yes.
great. Okay. That's, I think, voice of our Sharma ji.
Thank you, Vasthi.
Okay, so
Very
good.
clear.
So I think,
Sound
yeah,
is
it's
also very clear. So Shivanshu, sound is very clear, very clear.
great, great. So what we, like I mentioned, the first thing is that, while we are present in an array of commodities here the physical industry connect of our bullion contracts is something of a highlight, and something which has got created over a decade and a half. So it is a price benchmark for the value chain, and most of the pricing, we understand, takes place MCX plus minus when it comes to gold as well as silver. It is a hedge. See, it is a three-way hedge. It's important to understand the constitution of the price. While today the focus is not on hedging, but the constitution of the price is such that it takes into account the international prices, the domestic, the currency exchange rate, as well as the duty tariff. Now, before 2014, the duty tariff was at a fixed percentage basis. And then the government has started a system of introducing a fortnightly declaration of duty tariff, as well as the currency which is used to compute the import duty. So herein, immediately, what MCX has as a contract is probably something unique, because of the existing participation of hedgers, the immediate sensitivity to change in duty is also seen, and thereby it becomes a perfect hedge, you see. So it is a three-way hedge. Like I mentioned, importers to bullion traders, leading government nominated agencies who import, then bullion traders. Banks, of course, are not yet permitted. And in India, the gold is only canalized through banks. They don't carry any risk on their books, number one. So branded jewelers, retail chains, listed jewelers also trade here. I'm not taking any names, but you're aware, listed entities, big, refiners who are into custom smelting of base metals, etc. They're all participating for hedging. And the correlations are very important internationally as well as with domestic markets. Close to 99% correlations exist, which actually enable not only a great hedge, but also from the retail point of view, the real return. The trading hours, because of the location, geographical location of India, they allow for a presence into the global window, starting from Japan to the US. And hence, we at MCX reflect what happens at Tocom in the morning, then at Shanghai in the afternoon by noon, and then in the afternoon, the UK markets, which are one of the most liquid spot markets globally, and then followed by the evening COMEX when COMEX opens, which is supposed to be a liquid uh, electronic market for futures. So we reflect all of those movements and changes, and hence it becomes a very sensitive, script. So performance, of course, as you all would be knowing, MCX has delivered, Bullion has delivered excellent performance this year with an overall growth of 91%. That's in the financial year 1920 over the previous. And gold has actually doubled, more than doubled at 102% growth, 6,858 crores per day, and silver close to 4,400 crores at 76%. And on the right hand side is a column which depicts the May numbers. April, of course, was a complete lockdown. May numbers are at 14,135 crores, which is even higher than the entire FY 2021. Now coming to, so is the numbers of the open interest given there, you can see. So some of the highlights or the milestones which have been achieved recently. Total bullion turnover, highest in 6.5 years, 35,000 crores. This is on 16th of March. Similarly, volume, similarly for gold and silver individually. And gold options, which have become liquid over the past 2 years, they have registered a 1.5-year high in volumes, 9.5 tons, and all-time high open interest of 8.75 tons. It's interesting to note that gold options have hit the 2,000 crore plus number on more than 9 occasions in the past 2-3 months. So that talks about capturing the what do you call, the volatility, and being the ideal instruments to hedge volatility. Now coming to the retail oriented specific products, as you're aware that uh, it is a matter of uh, pride and humble offering of ours to the market, which actually is the first ever of its kind. It is a global first that we have launched a 1 gram deliverable gold contract called Gold Petal. This is the only such contract in the world. The advantages with this product are that it is the first ever. Of course, it is a retail-oriented product aimed at organized manner of investment and accumulation. You can hold it electronically, and it has a clear-cut demarcated making charge of only 100 rupees over the traded price. And the Comrisk system, which is the electronic holding enabled by MCX, that actually can be utilized by the retail investors. Now coming to the salient features, first is that it is your quality assurance. It is an LBMA approved coins only, which we the London Good delivery, and the last calendar day of the contract is when it expires. E+2 is the delivery period. The contract calendar is a monthly contract. It's a compulsory delivery contract, of course, and the final settlement price is the last day's old spot price of MCX plus 100 rupees. Mumbai delivery center and additional delivery centers at Ahmedabad and New Delhi. Electronic holding, it doesn't really matter where, if you're going to accumulate, so you can actually accumulate this product, and actually at different points in time, different prices. Unlike other asset classes, futures builds an additional advantage of having a liquid order book. So you can actually do a better weighted average. You can use your capital more efficiently in futures than other asset classes. I'm not trying to, this is not in derogation of any asset, any mode of investment. There are ETFs, there is a sovereign gold bond, but they have their own advantages. For example, sovereign gold bond talks about yield. So normally gold is looked at as an asset class which doesn't give any yield, but uh, actually when you compound its capital appreciation, then you realize that it was always there. Having said that, there is an interest yield in SGB, so that's one. But the liquidity is a challenge. I understand in the secondary market. Uh, Liquidity is not so much of a challenge in ETF. ETF is more about, but there's no leverage. There is no leverage as such. ETF is more convenience-oriented product, and it is physically backed, yes. But the distinct advantage which MCX futures has over both of these, SGB as well as ETF, and which cannot be denied, is the liquidity because of the diverse nature of participation. It is a comprehensive participation of retail on one side, traders on the other side, arbitrageurs on the in between, and the physical industry at the other side. So, uh, the pullback towards parity, there are many other factors which prevail, but that kind of the pullback towards parity and a true reflection of the rise or fall would be based on liquidity and participation, and which is uh, high to very high in MCX gold and silver contracts as seen in the order book. So if you look at, that is one of the biggest advantages. Of course, no, there is a leverage element to it, and you can use your capital efficiently because of margins and different locking in of prices. So these are some of the distinct advantages. And like I said, other modes of investment are also good, and they have their own advantages, which I only have listed before you just now. Coming to the second product which we launched, by the way, gold petal has delivered more than, so it's 13,178 coins before this expiry in the first 5 to 6 months of its existence. And similarly, we launched silver micro, again a retail oriented product, 1 kg silver bar, which again has done well. So basically it is 999 quality LBMA approved bar. LBMA approved suppliers who are in India, there are a few in silver. Unlike in gold, there's only one, but in silver there are probably 3. And so their bars have been seen to be coming in the first 2 expiries. The last calendar day is the expiry date, and E+2 is in silver micro the delivery settlement cycle. Compulsory delivery contract, 400 rupees is the making charge in this case, again transparent. And the final settlement price is the average of the last 3 days gold prices. And the delivery center for this is right now Ahmedabad. So again, this has delivered around 909 bars in the first 2 cycles. So we are very happy to note the market acceptance of these 2 products, which is one of the reasons why I wanted to today interact with all of you who represent the broking fraternity, as I understand, especially retail. So not only the delivery numbers, but if you look at the first table on this chart, on this slide, you see the way the turnover of these small contracts has panned out. This gold petal used to be 1.89 crores in 1819. It reached just short of 4 crores in 1920, and now it is 18 crores. So although it's a small contract, and we are not in these type of contracts for value or volume play. The idea is that today MCX has 30 lakh active UCCs. So you can well imagine if 1 gram accumulation starts in an organized way, what kind of a product this can become. And our idea is to offer to the market organized ways, like I said, of investing in this asset class. We are here for a long-term perspective, strategic perspective. Similarly, you can see the silver micro volumes, how they have panned out. Earlier, this used to be a cash settled contract, and we converted it into a 1 kg delivery recently in line with the regulatory mandate. So it was 332 crores, almost double. And here in May 20, it is further almost near about double of that. So it's a good response, I would say. And all these, products are LBMA approved bars. And incidentally, I'll just touch upon that MCX is also working on getting the Indian refined gold onto its platform. So we are going about it. We have received the applications of the refiners, and the further process is on, subject to approval of further regulatory committees. Now we have added, earlier we had added additional delivery centers in gold and gold mini, and in silver now from the May contract onwards we have added. Of course, this was a lockdown month, but we are anticipating that with the addition of these vibrant centers like Jaipur, Rajkot, Salem, Agra, these are all silver oriented. So we are hopeful that it creates more volumes of delivery and hedging. And the intention matching basis is followed for all other delivery centers, because we believe in one nation, one price, and that is the way it is normally in gold and silver, apart from these disruptive times. And silver basis center is Ahmedabad. So you can see, like I've mentioned, these two retail oriented. Other products are also retail oriented for that matter. It's not that they are not, but since these were new, so I've touched upon. So gold regular 1 kg can be an excellent HNI product. A gold mini anyway is an HNI product. It's a 100-gram bar, and Guinea is an 8-gram coin. So these three are equally important. You can see the graph of the volumes in the blue bars, how thick and recently in the past year and a half, especially, or two, not really that. So basically last year, you can see that it has started picking up in a bigger way, along with the price. So when this happens, it is reflective of retail interest equally, apart from hedging volumes. The volatility is given there. 2016, if you remember, was a fairly volatile year. I remember the first 6 months was very volatile, and then came the demonetization towards the last few months, November. So that changed things a little bit on the gold side, and the industry went through. It was a very positive move, and the industry went through its change and growth phase. And now I think the industry is more organized, the jewelry industry, and that is exactly what the government wanted. I think it's a great move to do. And 2019 saw 12% volatility as such. This year continues to see more volatility, and you can see that the chart on the right hand side is the CME gold versus the MCX movements. So all these products are deliverable products. All these products can be accumulated via Commerce and taken out for delivery whenever the customer wants. So these are just some of the stats. You can see 1 kg, 100 gram, 8 gram, 1 gram, and the price quote in normal, in the bigger contracts, is rupees per 10 gram. There in Guinea it is 8 gram. So and petal is 1 gram. So when you look at tick size, it's always it's the 1 rupee tick size. 3% is the daily price limit. The margins, which have been revised now, 6%, or span, initial margin is 6%, or the span based, whichever is higher. The staggered delivery period would be the last 5 days, working days. So you get 5 full days for delivery, and 5% incremental margin on each of those days. Delivery units are exactly equal to trading units. As you are aware, that's a regulatory mandate which we have converted. And the basic quality to deliver is 995 in the 1 kg and 100 grams, but in the others it is 999. They are investment items more and more. And even in the kilo and 100 gram, you can deliver 999, and you will be given the premium for that. And that is written on the right hand side in the last row. So the settlement DDR for those contracts is the last 3 days spot price, hold at Ahmedabad. Silver, again, 3 contracts, 2 I've discussed. Okay, silver mini is a 5 kg contract wherein you can actually give or take delivery of 5 1 kg bars. 5 kg bar itself is not a feasible product, not viable technically. We were thinking of doing that at one point in time, but no. After due discussion with all the refiners, it came to 5 bars of 1 kg each. And silver regular is the 30 kg bar, which is the format in which it is normally imported, made internationally, and imported into the country. And as you can see, the silver price movement, silver being a more volatile industrial metal, which takes its cues from gold as well as from industrial metals like copper. So, so today, if we may be, people may be having this feeling that silver hasn't performed as much as gold has. That's because the gold silver ratio reflected a number close to 125 recently. So some are of the view that silver is the next, uh, commodity where you can actually expect a sort of movement. And you can say that actually silver earlier, if you remember, it had reached levels of 74, 75,000 a few years back, in fact. And right now the 50,000 odd level in silver. And there's a lot of interest in silver ETFs also based on commodity derivatives in the ETF fraternity today as things stand. So this is basically just the difference here is just the denomination, delivery and trading unit. Otherwise it's all triple nine fineness bars. And the same DDR is the last 3 days spot price at Ahmedabad. This is a snapshot of the deliveries which have taken place at MCX. So delivery for us, although exchange is supposed to be a place of delivery of last resort, but what delivery does prove is acceptance of price by both the buyer and the seller. So that is an important thing. And we've had excellent deliveries on our platform since inception, close to 3,370 tons of silver and around 116 tons of gold in the various products have changed hands via our contracts. And this includes the delivery of, so like the role of an exchange is not only to provide a platform for speculation and risk management, but as well as price discovery. So it is often seen that whenever there are, while the government doesn't permit export of bullion, but then there are times when the domestic spot markets are actually going through a discount phase, heavy discount phase due to various reasons. So in such times, people even get the scrap jewelry converted into good delivery bars of the exchange, and they have actually delivered them all onto the exchange. Sometimes jewelers who have uh, seen effects of lockdown or other such things like strikes. Even in 2016, there was a strike. So exchange has always seen deliveries of sizable quantities during such times. And in the month of March, when there was a lockdown, again, MCX, there was no default in the March end delivery, that is the April gold. It was absolutely smooth, although the quantities were less because of availability. So delivery means that much, it has that type of a connotation. And delivery also, the threat of delivery actually keeps the pricing or the parity in check. So these are the reasons why delivery is important. For your context, delivery can be a sort of the retail investor's choice of accumulation, whether he wants to do in electronic form or in physical form. So those are the implications. Incidentally, in the month of August last year, we saw the highest ever delivery in a single contract of gold, which was 5,158 kgs, more than 5 tons, that is. So, and why I mentioned the some time back about the India Good Delivery Standard. So we had, I'll just dwell upon it. It's important for everyone to know things. So basically that in 2017 itself, we had come up with a draft. We led that initiative, and other important trade bodies of the country and other exchanges were also with us. And we all got together, and then we presented the draft to the BIS. And earlier this year, in the month of January, the BIS has finalized a draft which has those contents, which is a gold and silver bar standard for India. So now, basis that and basis other stringent eligibility norms and audit requirements, when these Indian refiners, we put them through that, and the ones who clear that, who clear that on a regular ongoing basis would remain to be exchange good delivery. And ultimately, the recycling vision of the government would also find itself aided that way, that that very recycled gold would come on the MCX platform and actually lead to a sort of a monetization as the GMS desires. So that is another vision which we are working on, subject to further regulatory approval. Now, to understand the international movements versus the MCX movements, you can see that a movement of $1, keeping the currency where it moves the gold prices by approximately 25 rupees per 10 gram. 25 rupees per 10 gram. Now, if you look at the rupee movement, if rupee moves by one notch, it impacts gold prices by 543 rupees, keeping the international prices constant. Similarly, for silver, a 0.01, that is a cent movement in silver internationally, it creates a 24 rupee movement here, and 559, keeping the international prices constant. We'll quickly go through your delivery process since you will be dealing with clients. And so all the contracts at MCX and Bullion are completely compulsory delivery contracts, first thing. So what that means is that all outstanding positions on the expiry of the contract which have not been settled, which are open, would be settled as per the due date rate. And the due date rate is calculated on the expiry day by taking the last 3 days spot market prices. We poll spot market prices twice a day and display them twice a day as well from our basis center, Ahmedabad. And in the contracts which are Mumbai based, it'll be obviously the Mumbai spot prices. And wherever the purity, the basic purity to deliver is 999, even though they may be polled at 995, they will be converted to 999. And of course, allowing for the grammage, and basically that is how the DDR is calculated. So on the 5 days, the delivery takes place on the first 4 days at the DOR, delivery order rate, and on the which is basically the last half an hour's trading average, and the final closeout happens at DDR, which is the last 3 days spot prices average, evening spot prices average. So there are the components I have already mentioned, inclusive of all taxes and levies relating to import duty, customs, but excluding GST and any other additional tax. So that is the pricing basis. Making charges have been kept separate to create transparency and to create better price discovery. It is 200 rupees for the Guinea, 100 rupees for the petal contract, and 400 for the micro, as well as the mini. The mini gets converted from this month expiry, June expiry. Earlier, both these contracts, mini and micro, were cash settled, and they were linked to the 30 kg. But as the regulatory mandate came for making everything deliverable, we have done so. And it seems successfully because both the contracts are seeing excellent deliveries. So delivery center, last 5 days, the intention is provided by the seller. First, he has to make a pay in his existing valid commodity balance in the Comrisk. And after doing so, his intention is valid. If he gives the intention on any of the 5 days, it's accepted. So let's say on the first day, 7:30, and then by 8 o'clock, it is displayed to the market. And basically, 8:30 on the respective tender days, it is displayed to the market. And all the open positions on that day, on the first, second, third, fourth, fifth, are actually matched with each other randomly, the seller's positions against the buyers, and whoever is on the buy side can be marked delivery on any of the days, if provided he's open till the end of the day. And if he really wants delivery on a particular day, he can also give the buying intention. he will be given preference accordingly on a price time priority basis. So the delivery pay-in as well as the payout, it takes place. So this is for gold, gold mini, and silver. And like I mentioned about the intentions to you already. So on the expiry, the next day, which is E+1, the delivery pay-in by 2 p.m. And the delivery payout and funds payout by 4 p.m. This is the norm, as well as for gold guinea, gold petal. The timing here is as per 3 p.m. is the intention, unlike 7:30. Rest of the things remain the same, except that these are E+2 settlement cycles which are run, and that's it. So all the 4 contracts are mentioned here: gold guinea, gold petal, silver mini, and silver micro. And the previous slide was with gold, gold mini, and the big silver. So there is a default penalty penal provision which is in place, which is to the tune of 3%. No buyer default is permitted, and up this 3% is a percentage-based premium, penalty. But we actually ensure that the entire transaction gets protected. How? That the next day's spot price, the next 2 days spot prices are compared, and whichever is, suppose it's a buyer, suppose the seller has defaulted, so if the buyer has had to pay extra money to buy that metal, so that replacement cost is also provided apart from this percentage penalty. So the difference between the higher of the next 2 days spot prices versus the exchange DDR, that is also taken. This is the penal provisions. These are just some of the basic charges. Vaulting charges for different denominations are mentioned. 35 kg per bar per day. Typically, gold comes in at the last day into the exchange vaults only for the settlement. Otherwise, they are kept in their own vaults where the charges may be different. So this is the exchange based charges. Gold guinea and gold petal is just 10 paisa per day. Gold mini is 3.5 rupees, and silver again 35 kgs 30 kg bar is 35 rupees, and so on. For silver it is 1.25 rupees per kg per day. Now so this is basically, till now I have covered the product details along with the settlement and delivery procedures as such, and the highlights of each product, what it really means. While I will not be covering hedging in detail, I can, if you want, for your clients. Then it is basically coverable in a few slides. If you want, I'll just quickly run through them. Because in the case of options, I know that there are a million strategies which retail customers may like to use in combination with futures, but I will try to explain the hedging strategy. So in that sense, it's a good thing. I'll quickly cover it, so it remains in your thoughts. So, of course, the advantages of hedging would be efficient use of capital, lock-in of the protection or lock-in of the profitability. That is the fabrication markup. The inventory remains hedged, and some of the advantages that the order books are well maintained. The hedge books ensure that the margins are in place for conversion. So, I mean, a long hedge is typically done to lock in prices of physical gold even when you don't have it physically. So that is a long hedge. As far as the offset hedging is concerned, it is taking the opposite position of an existing existing spot market position. So essentially, hedging tries to fill the gap between timing and material mismatches. Essentially, that's all there is. Basically, either you have the metal and you don't have the price locked in, or you want to lock in the price but you don't have the metal. It's very simple. So these two types of situations are covered by hedging. This is, of course, you have seen it. So this is the example of a price fix hedge. You can very well, I'm sure you must have gone through these over 10 years in different formats. So you can see that either way, there is no profit, no loss. So this is important to note here, that if you hedge via futures, there is no profit, no loss. However, when options come into play, things are slightly different. I'm coming to that. This is the other example where the price is not fixed. So long hedge and offset hedge, that's all. Yeah. So you can give this a quick read, what it actually means. And it is no surprise that yesterday we had a PAC meeting and I was going through statistics of value chain participation presence in futures as well as in options. And it was a very, very significant number in options. So which means that physical players in these past 2 years have started utilizing options one way or the other, whether it is by locking in the gold or silver when market is at discount and then market is still volatile, then locking in the selling calls slightly above the money and taking that premium and trying to remain protected over that discount plus premium what you get range and things like that. So I mean, physical industry is getting used to it, and a rather healthy number hedges by options. So you can see that it is an insurance against adverse movement, but it also allows for profit for participation on the favorable side. This is the important difference, and this is what, if you have hedger clients, from time to time options can also be used, and when to use futures and when to use options for hedging, we'll again come to that in the next slide. So the maximum loss is to the extent of the premium paid for the buyer. Of course, exchange traded options are free of counterparty risk. And you have, if you use them in combination, you have a safety of options and leverage of futures. So which means that you can profit from the change in future prices, but limit losses via options. And basis this, you are better positioned to offer maybe hundreds of different effective hedging strategies to your clients. Better cash flow management, one-time payment of premium only, low transaction costs, and low capital intensive. So while futures, they have M2M, they have a margin, etc. In the case of options, so there is a better cash flow management. For buyers of options, it's a one-time payment of premium. We've been in existence in options from the day of Dhanteras. I remember when we launched in Delhi at the hands of the Honorable late Shri Arun Jaitley ji, and that was in 2017. So in 2 years and a few months, they have come of age to an extent. Like I mentioned, they are showing good volumes now. And subject to regulatory approval, we may be coming up with what may be of interest to you, an option on the 100-gram contract, as well as on the silver silver mini. So this is subject to approval, but that can mean a lot, because earlier we could not do it on the 100-gram because the gold 100-gram futures did not have 1,000 crores. Eligibility norms were not met. But option in goods has come, notified by SEBI. The framework for that has been notified, and option in goods can pave the way for that 100-gram, which we may launch, subject to approval of the regulator. So, like I mentioned, various strategies can be used, but if you look at so we just examples of what some physical players are doing. This is an example of a costless collar, wherein gold producers, they sell above the money calls at premiums, which becomes a ceiling, and they buy protective puts below the money using that premium, and that creates a floor. So a zero cost hedging strategy. Some mining companies have talked about this. Now, coming to, yeah, this is an active example which you find, flexible pricing schemes. Many, for the past 2 years, some of the leading jewelry chains, including listed companies, have used this during the Diwali season, using our options contracts. So this involves buying put options to protect yourself across a time period. And during that time period, they are offering their clients, their walk-in clients, with the lower of the two prices, lower of the prices across that time frame. So this is achievable only by using options. So in this case, put options have come into play. So they buy a put at the price, at the time when they receive that customer's sort of advance and willingness is confirmed. And then let's say 15 days to Akshay Tritiya or Diwali, whatever it may be, they will say that, okay, today the price has fallen. So he'll call and book it. So they will square off those positions and they'll remain protected. So this is interesting. And then inventory hedging, of course, like I mentioned, some people write above the calls, right above the money calls, and they are able to protect against fall in prices, and profitability also remains across a range. Now, so when is it more feasible to look at options for hedging, and when is it more feasible to look at futures for hedging? Right, this is an important question. So you can see that the chart at the right hand side bottom. So volatility decides that. Volatility decides the answer to that question. It is a function of price movement, standard deviation of daily returns expressed in annualized terms. That is what an implied volatility is. So whenever the implied volatility is high, the risk premium is high. So when the risk premium increases in options, sometimes very dramatically, and at other times when the volatility comes down, the premiums decline. You must have seen this even in the equity side, IVIX, and so on. So for a hedger, it is easier to make a decision based on this, that, okay, I'm getting a premium of so much today for this call. Whereas, okay, now the premiums have fallen. So can I buy options? If the premiums are high, can I sell options? So you can actually hedge both ways, and also decide that, no, look, the risk premium is too high. My requirement is only to hedge so much, and it's okay, my capital is available for M2M, so I'll go for futures. So it is absolutely the decision of the informed hedger, or for you as a relationship manager or a research desk for those hedgers. And I'm using the term hedgers across these examples, but let me tell you, these are very much applicable to anybody who's taking a position to protect himself, whether it's an HNI or a retail customer. So that's why I wanted to cover these slides. Now, I think broadly we have covered to an extent, and hold on. Hmm. It seems to have. Okay, that's it. Yeah. So we have a few slides after thank you, but then those are all numerical examples, etc. So as the time permits today, I think it's better to now get into a discussion mode. So I'll hand it over to the host from our side, MCX side, and then me and Pooja, you're there. You will also field, some questions. We're happy to take questions now. Yes.
Dear participants, if you have any questions, please post them in the chat box. Shivanshu ji will be taking one by one.
or if they like, I mean, we can even we can discuss them, and anyone can speak it out as well. And my team is there, and we'll all be happy to take them. Please go, because chat box, I'm not seeing anything as of now. No, yeah. So somebody has asked about 100 gram. Yes. So we already have successful option contracts running on the option on futures mode. So this is a different category option in goods. So as and when we like, we may look at launching it. So both types have their own advantages to each other and disadvantages. Yeah. Sorry, there's a query about, one second. Is there any plan to discontinue gold and silver mini contracts in the future? No, no, no. Please let us be clear that as per, when we have a nomenclature called mini, okay, so unlike other commodity verticals, here mini doesn't mean it's a smaller version of that bigger contract. No, here every contract that we have is a unique product and it has its own market. Okay, so 100 gram bar is a B2C product. It has its own retail market. For example, a gold kilo is a B2B showroom oriented item, jewelry oriented item, manufacturing. So similarly, gold guinea is again a coin product. So every product here, including the 1 kg bar, etc., and silver also, they are of a different denomination and they have their own market as such. So no, when there was that regulatory move about minis in other segments, this was already been discussed. So in bullion, there is no such thing of any discontinuation. Yeah. Yeah, GST, of course, you see, we have always been of the opinion that the GST can be, the IGST should be imposable on all the sellers by the exchange, etc. So those things we have written to the government. As far as things stand right now, a retail bill also can be requested. If a guy, if a customer wants to buy like he goes to a shop, he gets a retail bill. If he wants to, he can get a retail bill also. Yeah. Okay. I hope I didn't miss any question. Yeah, please carry on. Next question, please. Any other question, please? Would you
Yes,
can even speak?
there is a question that why not parallel approval for MCX along with BSE and NSE in a chat.
No, I have already answered that.
Okay.
I have already answered that. We already have existing successful products in option on futures.
Okay.
So this is add-on. The moment we can consider launching it if we get the approval, because this is a different segment, option on goods, separate one. So weightage of gold as an asset class in a diversified portfolio, what should be the weightage having a mix of equity and fixed income, any broad range? So I think
There was a study actually done on this. There was a study actually which was done on this and which mentioned that at least 20% of your portfolio should consist of commodities so that you have a proper balance. Because whenever equities are not working, that time commodities do form
yeah, I think the voice is. Yeah, I think what I'll add to that, what Pooja is saying is that managed futures, there was a study that managed futures, which means essentially commodities. So to the degree of 20%, that portfolio
Hello?
which had these commodities, that portfolio seem to have optimal diversification and better return, best return. That was the thumb rule. Yes. Silver, Mini, and Micro. As of now, they are Ahmedabad-based delivery center. So when these products mature, we will look at expansion. Right now, we want to focus all liquidity at one place, but we look at it. We have the additional delivery centers. What we have expanded is for the silver 30 kg. It's an industrial, more of a B2B product, and therein we have kept things in mind, as in the ports, because silver to move silver, there would be some market between, let's say, Sri City to Coimbatore or Salem. So we have kept those type of things in mind. So before putting Chennai and Salem as delivery centers. Yeah. These ones will come to in due course. Okay. Just please ask further questions. So I think the
Dear
idea.
participants,
Sorry.
any further questions, please, from the audience?
I think in the meantime, while they are articulating, I'll just add one thing here, that, see, the thing is that the asset class of gold and silver, basically, bullion as an asset class, comes into flavor looking at various global macros, geopolitics, currency at different points in time, like it happened in 2008 to 2012, when it gave, I think, 48 to 50% return. Now, so while you may be sitting at a similar point of inflection for the past 1.5 years, and off late more so, and you may be entering a scenario wherein currency also, the relationships change, and geopolitics, of course, and economic turmoil and monetary easing. So it's important to arm the investors with this information and offer them a product portfolio which can fulfill that demand. So we have an array of futures products which have a delivery leg to them, which have an electronic holding and accumulation capacity, which have certain distinct advantages over other types of ways to invest in these assets. And those products also have their own advantages. I'm saying, so you have to be discerning in deciding who is the right customer. Suppose somebody wants to look at absolute return, no, I want yield also, fine. For him, there's a bond. So if somebody wants to, be practical, it doesn't matter whether it's gold or it is, who's quick on his feet, it doesn't matter whether it's gold or silver or copper or cotton, then MCX for him is the first choice, because he can look at shifting, arraying between the array. If there's somebody who wants to take physical delivery of quality assured product and accumulate it at various price points through a capital, efficient hedge at different points, paying margin, and he's happy to be keeping some M2M buffer, then MCX is the right choice for him. And the best part here is that we have an array of various denominations. He can even start accumulating at 1 gram. And a lot of this is happening. I mean, one of the leading Digi Gold companies, we have recently opened their account also. One of the leading digital gold. So, I mean, people are buying digital gold. Internationally, the bar and coin investment is at 7-year high in USA. ETF volumes have continuously swollen. But then ETF has a certain degree of liquidity and it does not allow leverage. It has a participation base which is mainly what? On the buy side, retail, and then the liquidity providers on the other side. Now, MCX has a broad participation. So what the fairness of the price which you would get and the fairness of the movement which you would get in a futures would be something which is more idyllic as compared to the other one. You see, because the participation base is so broad that it will eat away those inefficiencies in a better way. I'm not saying all the time, but in a better way. So these are some of the basic advantages you should talk about when we look at your retail clients. And the quality assurance is there in, I think, in both sides. So we also have LBMA approved, and the smaller, the 1 gram is in a tamper-proof type of a packing with like a credit card. So there are certain things which you can discuss and offer. Yeah. This is the broad theme, which I wanted to discuss with you. And I'm sure you would be getting a lot of queries. So if ETF volumes have swollen up, that means that during lockdown, people preferred to latch on to the asset class in some way or the other. So they chose. And the ones who came to futures in our volumes also is reflecting. You see, it's very clear. So when this lockdown completely opens, there may be situations in which people go and redeem old jewelry, either through NBFC route or through outright sale. So all that will be hedgeable. All these NBFC, some of them leading names which they are hedging on MCX, for example. So those volumes would also come. And smaller jewelers, you must target. I again say, smaller jewelers, you please target them aggressively, because for their own benefit, you see, because when they see a lot of gold coming for exchange of jewelry, by domestic households or for sale. So this is not the manner in which they are used to accumulating inventory. This is going to be at a much higher and much sporadic pace. So this will require a very dynamic, on their feet type of hedging on MCX. And this can only be done in a domestically denominated price, because it will be a duty paid price when somebody comes back to give jewelry. So these are the things you should talk to your jeweler clients, that this is going to happen. Already it is being seen in those places where lockdown has happened, and lockdown has opened and the jewelry markets are functional. Already it is being seen to some degree. So because the prices have also moved up in this lockdown, you're talking about a reasonable price movement, 6,000-7,000 rupees per 10 gram. So people may want to capitalize. We often hear that these days people are taking out the money from NBFCs. The gold back from NBFCs by paying the remainders, and actually then going and outright selling the gold because they want to take advantage. So such people, if you go and educate that, look, you can hedge it, you can take advantage by simply locking in the prices. So these are the things which you need to mention to the jewelers. We are there, I along with my team, for any technical subject understanding, etc., etc. So those things will continue. Just a second, please. Hello. Yes. So I know that broadly we have covered things, and we continue to be in touch on a one-to-one basis. So unless there is any specific query, we leave it at that and continue to remain in touch directly. And I would say very clear focus should be retail and jewelers. That's it. This is where you need to target. And while we are working at the strategic level, like I mentioned, few initiatives that will continue. As and when there is a development on that front, you'll get to know from us on the Indian good delivery front. As regards options, so also you will get to know from us. We anyway have a product which is doing very well, but we are open to adding to our portfolio via the other route of goods, option and goods. Yeah, because we have an underlying future which is very vibrant there. Gold 100 gram and gold kilo on a number of lots traded basis are very similar to each other. So liquidity. So we have these things in mind, and great. So good interaction with all of you. Thanks a lot. I'll just rush into another meeting, and I hand it over to BD to conclude the session. Thanks from my side.
Thank you, boss.
Shivanshu sir, thanks a lot for explaining us the cotton product, the gold and silver products. And it was really nice hearing you. We could understand how the delivery system work on MCX, the utility of gold petal, gold guinea contract for the retail investors, and large gold contract for the actual users. You also shared some views on options. I'm sure the participants would have really benefited from it. And we look forward for hearing you again for in future webinars. Thanks a lot, sir.
Thank you so
Dear
much.
participants, before you get the webinar, we would require your feedback. It is for our internal compliance purpose. So my colleague Pratik is posting some questions. Please provide your feedback. It will be really appreciative of you. Thanks a lot.